You've saved the money. Now you're staring at the transfer button, terrified. Deploy it all today, and the market could crash tomorrow. Hold it back, and you watch the market hit all-time highs while your cash loses value. The financial industry offers two warring camps to solve this. Camp SIP tells you that rupee cost averaging always wins, protecting you from volatility. Camp Lump Sum insists time in the market beats timing the market, urging you to invest immediately. Whether you are deciding what to do with a portion of your monthly salary or a sudden financial windfall, the fear of making the mathematically wrong choice is paralyzing. We ran the numbers on 23 years of Nifty 50 data, testing every possible 5, 7, 10, and 15-year investment window. That is 704 distinct rolling periods. This chart shows the win rates for both methods across those 4 time horizons. Whether you look at a 5-year stretch or a 15-year stretch, the results are nearly dead even. It's essentially a coin flip, but neither method is a magic bullet. The winner in any historical scenario was dictated entirely by the specific market conditions on the day the investor started. The mental energy you spend agonizing over the perfect deployment method is largely wasted. Let's look at exactly when each method wins and what actually drives real wealth creation. Most online debates rely on a flawed shortcut to compare these two methods. They use simple compound annual growth rate, or CAGR, for everything, which artificially makes SIPs look terrible. The correct way to measure an SIP is extended internal rate of return, or XIRR. It accounts for the time value of money, properly crediting the installments you made early on that have been compounding the longest. For a lump sum investment, standard CAGR is perfectly accurate because your entire principal is exposed to the market from day one. When you measure SIPs with XIRR and lump sums with CAGR, the playing field levels out. Only then can we fairly evaluate their true trade-offs. So when does lump sum actually dominate? The first scenario is deploying your capital at the very beginning of a multi-year sustained bull market. The second scenario is a V-shaped crash recovery, where deploying your full capital at the absolute bottom captures the entire upward rebound. The March 2020 COVID-19 crash is the ultimate historical example of this outperformance. Because the entire principal was exposed to immediate compound growth as the lockdown lifted, lump sum investors beat SIP investors by over 8% in that specific 5-year window, and up to 11% in similar historical recoveries. But capturing those outsized gains requires perfect market timing. You have to know you are at the absolute bottom. Lump sum maximizes mathematical returns in a rising market, but it exposes you to maximum psychological panic if the market crashes the very next day. SIPs thrive in the exact opposite environment. They win when you enter the market just before a crash, or during a prolonged, volatile, sideways market. During the 2008 financial crisis, a lump sum investor who bought at the peak bled cash for years. Meanwhile, the SIP investor kept buying increasingly cheaper units month after month. That systematic accumulation during maximum fear meant that when the market eventually recovered, those cheap units supercharged their returns. But SIPs have their own hidden cost: cash drag. If you are sitting on cash during a 10-year bull market, waiting for your monthly SIP slot, your uninvested money loses out to inflation and market momentum. And then there is the uncomfortable truth of the lost decade. Between 2010 and 2020, India saw flat, volatile markets, where both SIPs and lump sums yielded sub-8% returns, barely beating a fixed deposit. No deployment method can magically fix a stagnant asset. Accepting this forces you to realize that the method you choose relies heavily on market regime luck rather than bulletproof strategy. Successful investing requires matching your deployment method to your actual cash flow and psychological risk tolerance. If you invest from your monthly income, SIP is your default, and really your only practical choice. For the salaried earner, the true benefit of an SIP isn't catching market bottoms. It's absolute behavioral discipline and automation. If you've received a large sudden windfall, deploying it all at once maximizes your potential returns, provided you can stomach the severe emotional risk of a sudden drop. If you have that same windfall, but the thought of a market drop keeps you awake, you should use the staggered lump sum compromise. You deploy the capital in 3 to 4 equal tranches over 6 to 12 months. Staggering sacrifices the absolute peak returns of a perfectly timed lump sum, but it successfully purchases peace of mind and protection against immediate crash anxiety. Most investors focus on the timing of their entry, but data suggests the entry method is the least impactful part. The average annual return gap between SIP and lump sum on the Nifty 50 is just 0.49%. But strategy selection, like moving to a low volatility factor, increases returns by 2.26% annually. This 5 times larger gap proves strategy is a far more powerful wealth driver. Agonizing over the perfect entry date while blindly buying an index is an illusion of control. Stop obsessing over the exact day you put your money in. Financial discipline and the quality of your underlying strategy are the ultimate true sources of alpha.